Hello, welcome back. This is the chart of Amazon 2023 April earnings, what we are projecting. A couple of things are happening here. We are looking at some Tesla frequency models. We are looking at market maker models, which we always have to because this is where the big monies are going to. And we're converging them into vortex models. And here are just like a trend models implemented on top of it. Uh, these are daily charts, right? We can also do low level, small 5 minute, 20 minutes, low frequencies also where market is going to obey on those frequencies. But these are used for, this is earnings play and this is a long-term positional plays where which is the best bias opportunities. Now, if it gets to this level, maybe in 6 months, maybe in 3 months, maybe before earnings, we're not projecting the time. If it gets there, you will see the delta flows showing up in your order flow. So this is why we put a lot of pressure on these levels. So levels are 70. Obviously, retest of this is there. I didn't put it. These are also levels for Tesla. It can go to 95, and just that could be the low and take off. And I'm looking at a larger target, so you can hold these positions for multi-year positions, right? So where, let's say you want to buy premium and profits. So what do? You sell puts. How do you sell puts? Well, market volatility goes up, you go and panic into your level, you sell puts 25 deltas below where you are currently at. So which means when the market rallies, your powers are limited as well. Synthetic long stocks, right? That is tactical moves. So that way, you have to use the model for the right market. Right now, there's no premiums are not that much in the market. Selling things right now is not a good idea because volatility is implied volatility is not giving an extra bias for collecting premiums, right? We need to be, VIX has to be a certain level, implied volatility has to be a certain level, levels have to be at a certain level, and then you collect your premiums. It's all about risk reward, right? So now there are much better effective strategies. Can be hedged or unhedged, biased or unbiased, data neutral strategies for the moment in time. The moment in time is that volatility is now compressed. So whenever it takes off, now you can see we are building a very large base technically as well, right? Building this like you have a in this, you're building a very large base. Now if this is daily, if I go to weekly, if we go to monthly, it's like basing here, right? There's a very large base is coming up. So one of the tricks what you can do is the width of the base. The width of the base should be, excuse me, let's say this is the width of the base, right? Now this width of the base, more time you go across the base, bigger moves will take place once you leave this base. And what will spook the market to do it? We're not talking about tail risk, we're not talking about the structural shock, we're not talking about any geopolitical shocks, we're talking about the earning play. That's why we call it earning plays. And these other levels, lower 70, 149 on the top, 177, 184, and the width of the base can also be, you're giving you estimate on the either side where market should go. But we have much more better sophisticated models which you are experiencing right now with the levels. So this is just like a tip on the side, and you can see this is where all the breaks work out, right? So these boxes here you see are your telling you break, retest. These are the three different risk levels you can consume once you have the bias, right? These are helping you with the entry part of it. So This is once you have the bias, right? So right now we're not discussing the bias meters anywhere. Right now we're just giving you very high level information. And once you get to this level, these are the best areas to make your trades, where market makers will start showing their delta hands, which you will see in your prints. But you know right now where the prints will come, and that's what I'm telling you. Thank you.